Could it be that we're all missing something in markets at this stage? 2018's return of the Volmageddon panic could be just around the corner as short volatility bets are starting to get squeezed. That, along with the biggest earnings announcement, is coming up in less than 48 hours. So it means that we need to bunker down and take a look at all the key levels together. S&P 500 reached that big 20 daily moving average. The Qs held barely through the session, and the VIX almost made a huge flip around. So with CTAs starting to show signs of selling for the first time realistically since October, could we be starting to get a weakened market? Well, it all comes down to a couple of charts, and in today's video, we'll cover them all, along with stocks, commodities, and cryptos around the world. Well, welcome back everyone to one of the largest daily shows on the internet right now where we talk about markets around the world. My name's Tom, and if you love markets, remember to subscribe and smash that like button. It was a sea of green and only defensives over the last 24 hours as we saw markets hunker in to the big earnings announcement coming. But also, as we mentioned, that Volmageddon panic is starting to take control as the VIX approaches a key inflection point. As we reported on our weekly newsletter, which is back, make sure links in the description down below if you want to sign up for that for next week, we talked about the idea of seasonal weakness returning, and it looks like so far so good, but key levels are coming up, including the 20-day moving average, which is probably going to get pressured during the Nvidia announcement. Speaking of Nvidia earnings, it is not like any other. An 11% move on a $1 trillion business that is now the third largest weighting in the S&P is no joke. And 58% of you returned a report that said that you are bearish into the event. Are you correct? Are you going to be wrong? The trend obviously is still intact to be bullish, but what it is going to be is fireworks for the session. And of course, if the stock does end up falling a lot like SMCI did, is a good scenario that it's probably going to be one of these two events. I also posted that over on our X account, which you can follow in the links. So let's talk now what's going on from the retail mindset perspective. Not only have we seen S&P 500 CFD and futures trades move towards the bull side a little bit more, which is the first time we've had that since October, moving into the 60s in terms of only how many bears are out there versus usually an 80 to 85% bear run, but we also have huge amounts of calls. Now take a look at this. We haven't had this report for quite some time, and every time we've gotten this high on calls, we've generally seen pullbacks in the market. Most notably, June, July of 23, we saw a sell-off from that event, and also, of course, the October 2020, and the most notable of all, the massive and crazy run of February 2021. So why could this be happening? Well, it turns out it's a mixture of us, the retail traders out there, and also hedge funds getting a little bit wild. Now, as we're about to talk about later on, we'll talk CTAs and how they're starting to potentially sell positions, the 20-day moving average probably being a catalyst for them. But this is a huge event here. Single stock legs are approaching some epic levels, and we haven't had it in a while now for single stocks. So it shows you that euphoria is definitely there. And every time the markets pull back, we are conditioned at this stage to buy the dip. And that's showing up in options markets around the world. So let's now talk CTAs because there were some big changes over the last 24 hours. Firstly, why are we looking at it? Because we know that these can be inflection points for markets. If CTAs start to sell, it can show you that smart money is getting out of the markets and we may need to be paying attention to it. Last week, we reported that BNP had a few strategies here that mostly showed that CTAs would reduce positioning, and it looks like that's already starting to come through with the Tuesday trade. Take a look at this chart here. The first time we've seen CTAs realistically have a notable sell-off right at those similar periods here on the S&P that we had back in July. So with this in options, it's starting to look a little bit bearish. And of course, if we get through that 20-day moving average, it's going to be a big zone. Here's another one that's just interesting from the inflation report last week, which was that the New York Stock Exchange had a 90% downside volume occurring, and we were within 3 sessions of a record high. Not too many reads, but we generally got a pullback from this event or a market kind of trading around the same range, what we call a pullback in time. And both were occurring during that point. So with an S&P 500 election year seasonal pattern now in place, which happens usually around the 3rd week options expiration, that was last week, by the way, we tend to usually see weakness that comes through into March, especially when we have a sitting president running. And that's what's happening so far, at least in the US. Here's just an interesting one for all the biggest bears out there. The correlation metric with, of course, 1929. Now, I hope this one doesn't happen. I'm sure a few of you probably do hope it happens, but this is a very wild correlation. 0.94 with 1929, and it turns out we are actually starting to sell just as we reach that peak. Not only were we hitting a 5K number, but on top of that, we were seeing a very big correlation with that big sell-off that ended up turning into a waterfall. Let's now go with slow pace of rate cuts. This is a chart that I think everybody that's new to this channel or has been subscribed for a while should be taking a screenshot of. It shows you the speed of cuts and why that's going to be important this year. Remember, the central banks around the world do not rate cut out of the goodness of their heart. So if you're feeling like a bull right now, which markets are the best? Well, we've been talking about Russell 2K a little bit. And then one of the reasons is while this reading here shows you that the Russell 2K might actually do a little bit poorly over the next couple of months, especially if we go into a pullback, it generally comes out of the gates very strong afterwards. Notice the similar reads and how we had kind of a bottoming effect on markets. So I think the Russell is going to be a very big one for the rest of 2024. And the reason why? Well, it's cheap in comparison to the S&P 500, notably because of regional banking, which obviously if you take out, it becomes a little bit less cheap, but still it's quite a lot under where it was back in 2021. It's also very susceptible to yield. So remember, if you end up seeing your yields drop off during 24 and that ends up occurring, it will do better because we know it's very, very much in line with yields at this stage, at least the way it has been trading. S&P 500 and the big zones, 5,000, we know it's a metric that we've been talking about, 4,000, 5,000, 3,000, all of these levels. Generally, we either see a pullback just before or we get one during it. So this is something that I'm keeping in the back of my mind, and we've been talking about it a few times as well. So the VIX, the Volmageddon, the big key levels, 16 being a massive point of inflection. You'll notice here 1550 to 16 is basically where we're going to see a gamma wall, a switch which could squeeze out quite a lot of people and cause that Volmageddon style panic. Now you might say we've learned from 2018, but let's be real. A lot of the time markets don't learn from certain situations, and this is going to be a big wall. So remember, a close above 16 on the VIX is probably meaning we're getting through the 20-day moving average, which means that volatility is going to spike in a big way. And it might bring even over 20 very, very soon. So where are the market opportunities other than the US right now? We've talked a little bit about China's thrust. We've obviously talked about the big levels here in terms of panic breadth, getting to the biggest levels that we'd seen in a while, everyone turning negative on this market, and then some signs of life from the price action based standpoint. And obviously the Shanghai Composite in particular is showing that signs are generally pretty good in similar reads to this over the next 12 months. Some other things that are looking good, obviously the China aging faster than the US population issue, that's bad. And long term, this will be an epic issue for the country. But for the short term, we've got Lunar New Year, which is coming to an end. Obviously an uptick that tends to come through from a seasonality perspective here. And we also have China's main regulator getting wiped out, which is something that we tend to see at the bottoming of markets as well. This is also another one which is interesting, which is a defined outcome ETF. We just saw one launch recently in the ETF space throughout China, and that shows you usually people are kind of hitting that mass panic kind of button and looking for the safest ways. When you see safe funds come out, often that is bottomings of markets as we saw in that chart. So let's move over to the big information coming in less than 24 hours, and that's of course Nvidia. This is going to be a $100 billion plus movement that's going to come through from the options market. At least that's what's expected. And you can see it's probably the most volatile period of all of earnings, just because this stock has now become the third largest part of the S&P 500. What levels are we watching? Well, let's just quickly talk about S&P 500 zones in particular here. And you can see that 5,000 remains very sticky along with 5,050. And we also know that this level around 49.50, 49.70 has become semi-important. As we reported, if we get underneath the daily 20 moving average, so that's the day 20 moving average, we know that we're going to probably move from what we call a positive gamma situation into a negative gamma situation. And that's a fairly large switch. So we'll be watching that along with the biggest levels for Nvidia, because of course 750 is currently one of the big call walls. 700 is now the short-term time frame resistance that could stretch it out, and put support isn't really found till 640 on the stock. So it's going to be volatile. 640 is the put stock level, and 700 is the current call resistance, with a break above 750 exposing 800 to even possibly a 1K kind of number. And you'd be surprised how many economists are upgrading that stock right now. I saw a lot come through over the last 24 hours. What about Tesla, though? We talked about the 200 call wall being a bit of an issue. Well, it looks like it's found a similar level of support around 185 to 189. So it'd be good to see Tesla hold this zone. It did sell over 3% on the last session. Let's now talk unusual volumes. It's been a while since we've been able to bring any of these back up, but we do have S&P 500 clustering all around here. Somebody's probably selling the S&P and taking some profits. And you can see here that we have the number 1 and 3 trades that are in that cluster for this particular fund being SPLG. Now, it's only one fund, but often we will find some of these sneaky kind of trades coming through. And it does look like someone's taken at least some form of profit. When we move over to options, it becomes a different world. Buy the dip is entrenched. Why do we know that? Take a look at this. A sell day in the markets traditionally would usually get puts. Not this time, guys. 58% calls through and 30% of transaction single legs coming from us, the retail traders. If that doesn't sound ominous, I don't know what does. But at this stage, we're still in that overall upward trend. And of course, markets have been, in general, finding some kind of bull support every time they've been hitting that 20 moving average. And if price action dictates that markets should be moving up, maybe it's better to go with that side. Let's now talk about what's happened, though, because last 24 hours was defensive. Utilities, staples, gold. Only healthcare was down about 0.34, but it certainly wasn't anything to do with the most hot sectors right now, which have been consumer discretionary, technology, and semis. They were down pretty hard on the session, with Nvidia realistically causing most of the sell. Now, why are we worried about these markets? A lot of it has to do with these signs that we haven't seen in a while. The skew crush, a massive crush coming through that's synonymous often with markets having a pullback in time or a weakness period. Similar skew crushes this large cause sell-offs in markets, or at least some type of sideways action over the next couple of months. It's not looking great for markets from the skew perspective, but we've also got central bank liquidity not really showing support over the last couple of 100 points on markets. Still sidelining for now, and obviously if that starts to drop heavily, we'll be the first to report it here, so make sure to sub for that type of stuff. US yields weren't really in focus. I think yields dropped throughout the session, but still remaining quite high. And the US 10-year remains a possibility to get back to 4.5%, which often, if it does, that's going to be a bit of an issue. Now, a few of you correctly are pointing out a couple of things. You're correctly pointing out that bonds like treasuries are not freaking out. You've also noticed that high yield bonds are not freaking out. These are all positive signs for markets for sure. Home builders, not currently freaking out. If we get through the 20-day moving average, then of course we could be seeing that. So this could be all part of a rotational shift from the Mag 6 to others. And this particular indicator as well suggests that. This is our bond indicator, suggesting that the markets are not freaking out just yet. If that changes, again, we'll be the first to report it to you all. So what have we been noticing? Last week we reported on copper. Now, copper was looking really good, and it's been one of the better trades. I've actually really enjoyed the copper trade. We started talking about copper trade down in here. We've obviously liked it since that point, and it does look like copper's trying to push that 395 to 4 kind of zone. Now, if it gets through 4, it's going to show you that inflation in some ways could be back, and it's pretty worrying sign for some of the stock bulls out there. So copper certainly on its run right now, looking like it has maybe a little bit more left in it. The US dollar, that came down to the 20-day moving average, which you're going to see a few times in this video, because we know that's been susceptible to really where the bears lose control and the bulls get back in. And we're still in a series of higher highs and higher lows. So theoretically, dollar index is still bullish. It's come back down to the key level here. And for most bulls, you'd be wanting to see some trade action around here. And I think there's going to be some great levels for bulls if they are broken through over the next 24 hours. One to certainly watch. UK oil, we've talked a little bit about oil's breakout towards the bull side. It was weak on the session. UK oil obviously struggling a little bit around the resistance, and even US oil, which is a spot, starting to struggle a little bit around the resistance. Now, daily closures were certainly very good, but you can see here we're still not quite above these wicks. So I've got an alert above 79, 77 just in case, but the trend is still higher highs and higher lows, with the more likely outcome at this stage being 82.50 to 84.50 for oil. One to watch and pay attention to, especially over the next couple of trading sessions. What about gold? It's back to the most traded zone, so just a key level for gold approaching, certainly something we're looking at and paying attention to. And then, of course, we also have our individual stocks. Tesla struggling, but then buying back up. 195-ish zone becoming very important now for the puts to hold. So we want to see that being where buyers find support for this stock. And 200 needs to be broken and closed above. And that's probably going to be a fairly bullish catalyst. As we've talked since the earnings was not so good, we've talked more about credit, selling being the best kind of force of action if you know what you're doing. It's been a pretty good level and so far burnt quite a lot of time. ARK still looking okay on the charts. Long leg doji last week, obviously sell off so far this week. But in general, basing formations along a lot of these Russell style 2021 popular growth stocks. A lot of them are basing and starting to actually show some signs of strength. Let's move over to SMCI because it lost a lot and then closed as a bullish pin. Now, this market doesn't care about the rest of the markets in its own world at this stage. And you can see here it closed as a bullish pin. And we've got a key level that we can now set an alert at for this market being 847. Now, I'm thinking that retail traders are going to like this stock. They're looking at it. They're saying, wow, I'm getting a 30% discount. How good am I? Smiley face. And you're trying to buy it up. And this is what we call elastic demand. So in general, there are some traders out there with elastic demand. I would say, though, that some big players come in, and there's a great chance that this is a pullback in time where the market goes sideways for substantially quite a while, months and months, or even a pullback that then gets led into a sell. A very important point for SMCI and therefore for Nvidia, because if Nvidia ends up selling a lot as well, it's looking very, very shaky. Remember, we've had similar rallies and they often come in with still great earnings. Don't get me wrong, I think the earnings are going to be pretty good, but you've got to hit those expectations. So you need a 10 out of 10 and not something like a 7 out of 10 when it comes to expectations. This is what we're looking at across the board. And we're definitely watching Nvidia very, very closely over the next 24 hours. Look at our post report when that market is coming through. It's going to be very volatile. Let's move over to indices right now. Aussie market holding up pretty well thanks to banks, actually. And you can still see here, we've got a bunch of wicks. If we breach the top, you're probably looking at further momentum to the upside. Just remember, if you're an Australian trader, you're trading really banks, energy, and in general, iron ore or materials and metals. So that tends to be how the market does end up trading. The HSI, the Chinese market, still looking pretty good. 16,500 coming under some pressure, but not broken through for momentum traders. So we're looking at a breakthrough here being very, very important to this market. And obviously we'll be paying attention to that. Look for updates very soon on that one. Now let's move over to the US market though. So we're still struggling a little bit here with the Russell. The Russell was holding up pre-session very well, ended up losing through the session a little bit, and it's still making a series of higher highs and higher lows. So for now, rotation does seem to be set, and I still favor the Russell. The only problem is, as we saw with the stats before, we often see a kind of 1 month sideways action here with similar reports, with then, up, down, all around, kind of a lot of percentage, but still sideways. And then we tend to see a bullish reaction. The 2100 zone being a huge weekly close for us. So we've got alerts up there just in case. But yeah, we hit the top. We've sold a little bit. I've obviously got 2090 as a possible gain here. And the next 24 hours is probably going to dictate a lot of this. Let's now move over to the VIX here for a second. Just remember, above 16 is going to be a huge breach out for the VIX. And if that does happen and daily close occurs through here, we could be looking at a very significant rise in the VIX, getting up to 20 very fast. That's going to be coupled with these reads. Now we're going to look at Qs here because if the Qs get through the 20-day moving average, that's a big deal. We've had one breach. We haven't had a breach on the S&P, which we'll look at in a second, but this is a huge level and you can see it held just barely over the last 24 hours, showing that the market's really waiting for the FOMC meeting minutes and of course, Nvidia's big announcement. Then the same for the US 500. You can see here 20-day moving average. Every single pullback has been met by buyers around this level. So at this stage, markets are still looking better at these points, and you'll be wanting to dial in on smaller timeframes and look at structure. We don't have too much on the structure there, but what I can say to you is that the things like the Qs here are in extremely overbought zones. That one particular indicator is showing a pretty rare signal that is showing maybe the top is in. And now I don't always just go with one indicator, but it's an interesting read seeing it up there in the highs. Speaking of some big highs, we've also got huge reads on Bitcoin. As we mentioned, between 51 and 55 is where we expect consolidation. Huge move up ahead of the Bitcoin halving event, usually a bullish period of time for it. I think it's the most aggressive market we've ever seen heading into a Bitcoin halving though, so a lot of people are on board that. And this is where I expect some consolidation. And we'll report more on that once we start to see the markets cool down, because of course, Nvidia is the current focus. Just remember, news ahead, FOMC meeting minutes, 2 p.m. New York time. Make sure to follow that. This is the rest of the information coming this week. And sign up for our free weekly newsletter if you enjoyed today's video, and subscribe and hit that bell. It's totally free, and we've got great insights coming your way. Thanks so much for watching, guys. We'll see you in the next one. And I'll see you in less than 24 hours with a huge report on Nvidia. Hundreds of billions at stake. What's your bet? Bull or bear? Let us know in the comments down below. Catch ya.